Hello there, finance friends. We're entering a new module. And in this module, we're going to be covering a topic that is sort of just taken for granted in America, but that you really need to understand. And we're talking about credit and debt. So we're going to enter a new module where we're going to be talking about understanding and managing credit and debt. We're going to break this up into three videos. In this first one, we're going to quickly go through just the understanding from a systems lens, from a conceptual lens, to get the context of what credit is and what debt is. We're going to talk about a few basic ratios, about good debt and bad debt, and about your FICO score. Okay, so that's this one. Then from there, we're going to break it up and have two separate videos. One about a particular form of credit called open-ended credit, which you might better know as a credit card. We'll discuss credit cards in one video. And then in another video, we'll discuss what's called closed-end credit. And closed-end credit refers to specific loans, also called installment loans, that you get for specific purposes, like a student loan, a car loan, a mortgage loan. Okay? The big goals that I really want you to think through are what decisions will you make right now as you're starting your journey so that you can build a really, really solid credit score. Because as we're going to learn, a good credit score is very important to have. It has a lot of impacts on you. So you want to build it good and protect it. And that comes down to making smart decisions. So let's just jump in and let's just start with an opening idea of what credit is and why it matters. So, what is credit? Why does it matter? So, when we talk about the term credit, we're usually it's a very general word, and it sort of has in personal finance two meanings. The first meaning is from the borrowing lens. So you can think of credit as any arrangement to get goods now, to get goods or services now. Actually, we could say goods or services or cash now. So you can think of credit as any arrangement to get goods or services or cash now and to pay for it later. So you can think of credit as any arrangement, any tool that allows you to get access to goods or services or even cash right now and then pay it later. Notice that by bringing in the ideas of getting it now and paying for it later, we know we're talking about time. So we know that we're talking here about time and that our time value concepts will probably come back into play. And in fact, if you take out a loan, for example, the value of the loan right now is the present value. And when you pay it off, it'll be paid off. So usually zeros your future value. And when you get something now and have to pay for it later, you have to pay some interest on it. And that's going to lead to interest payments. And you'll be paying those back over a period of time. So from a systems lens, from an integrative lens, we can already see that credit, this idea of getting something now and paying for it later, we're going to be bringing in some time value analysis. Okay. The second meaning of credit is a much broader sense. Credit can be seen as a reflection of your overall trustworthiness. Now, we're not talking trustworthiness as a person. This is from a financial lens. But your credit and your credit score ultimately reflect how trustworthy you are perceived to be by the people who you may one day need to get credit or a loan from. Okay? So credit is both a specific arrangement to get things, in which case we can say that credit is a tool, and credit's also a reflection of you. So in that sense, it's sort of tied to your financial reputation. Okay? Now, we mentioned that you're going to get something now and pay it off later. So another way to think about credit is through the lens of current you and future you. When you take out credit, current you is getting something today. So current you is getting the asset, the thing. But by taking out credit and taking out a loan, current you is also getting the liability. And future you, so this is transferring that liability from current you to future you. Future you has to pay it off. So effectively, whenever you take out credit, current you is putting interest payments on future you. Okay? I'm not saying that this is wrong. It's just important to realize. And we know that interest is an opportunity cost. So again, none of this is designed to be judgmental. It's getting you to be thinking about things through the systems lens, that when you take on debt, when you take advantage of credit, current you is benefiting and future you is going to be paying the tab. And when we move money from now to the future, there's going to be an interest component. And that interest is an opportunity cost. We can also therefore see credit through our systems lens. We know, for example, we can look at it a couple ways. We know that we have income, and that income is sort of filling our bucket, and that we have expenses. Well, when you take on debt, future you, so we're going to say this is your future income, a part of that has to go out to paying the interest, to paying it back. So it's also important to think that from a systems lens, from our lens of flows and stocks, taking on debt, utilizing credit, current you gets the asset, but future you is going to have some money taken out of that bucket to pay the expense. Okay? We've also talked about cash management. So another way to think about it from a systems lens is this. We have income, and we're going to pay some taxes, and then we're going to have our net income. Well, that net income, as we know, can go to obligations, luxuries, and savings and investment. Remember, obligations and luxuries, this is current you. This is current you. Savings and investment, this is future you. So from that lens, we put some time component on it. But think about this. We said that when you take on debt, you're paying interest. Well, interest payments are one of your obligations. So if you take on debt, and especially if you take on excessive debt, if you use credit incorrectly or unwisely, you're going to have to pay a lot more of your income toward obligations, which means that the amount of your income that's left over for your savings and investment is going to fall. You're going to have less money available to invest. And of course, from a systems lens, this affects you in this way. The whole crux of investing is you take income and you invest it. When you invest, you buy assets, and those assets generate cash. Assets generate cash. So the more you invest, the more assets you buy, the more cash you generate. But we have a great feedback loop here because that cash becomes new income to you. The cash that your investments generate becomes income. This was this compounding idea that we learned about. Well, the income you then use to buy even more assets, which generates more cash and gives you more and more and more. And over time, compounding looks like this. Income is used to buy assets. The assets generate more cash. You use those assets to buy, sorry, forgive me. Income generates assets. The assets generate cash. You feed that cash back into your system. That arrow gets bigger and fatter and bigger and fatter. And pretty soon, you're making as much money on your investment assets as you would on your job. That's the nature of investing. That's the goal, that we separate our labor from our income. That's the system. But you can see that this thing right here is a subset of that. If you take on debt, think of the cause and effect. If you take on debt and you have to pay interest, your obligations go up. So the amount left over for savings and investment goes down. So this number here goes down, and this feedback system never gets a chance to get going. So be really aware of the opportunity cost through a systems lens of your debt. Be really thinking about the fact that, you've got this bucket that you're trying to fill up with money, and you want to maximize the amount going in and minimize the expenses going out. Well, interest is a big expense. It's a big hole in your bucket. Okay. So let's always be thinking about our systems and about our feedback loops and about the integration, how the different pieces fit together. Always seeing we've got the big picture here and we've got a little subset of it here, but they all come together. Okay. So then you're thinking, well, Eric, are you saying to avoid all debt? Well, I wouldn't say that. And what I want to do now is introduce you to an idea of good debt versus bad debt. Because the reality is, if you want to be a good thinker, you're going to want to always be thinking in a critical way about everything in finance, but especially debt. Because the reality is that there's some good debt. Let's remember that when you take on debt, when you use credit, you are taking on the ownership of an asset now. Like when you take on credit, when you borrow money, you're getting the asset now and you're paying back the liability and the interest later. So the real question of debt comes down, what's the quality of the asset? And the key here is to understand that when it comes to assets, there are some assets that appreciate in value. And there are some assets that depreciate in value. So good debt and bad debt comes down to, that if you take on debt, you're going to be paying interest later. Future you is going to have a claim against future you's income. The real fundamental question then is, what's the nature of the asset that was acquired with the debt? And I would recommend to you that good debt is debt to acquire assets that appreciate in value. What are some assets that might appreciate in value? Well, a house. So a mortgage is probably good debt. What's another asset that appreciates in value? You, your brain, your earning power. So perhaps student loans or any sort of, and we got to be careful with the amounts, but any sort of debt that might lead to self-improvement, allowing you to generate more assets in the future is probably a good idea. There's some people who would say that a business loan could be good debt. To me, it's sort of risky, but it's a viable idea. But it would come down to, are you taking on the debt with a definite plan that you think has a good probability of growing your business's value? Okay, so those are some assets that might appreciate in value. Bad debt is going to be debt to buy assets that depreciate in value. You don't want to do this. You don't want to take on a loan right now to acquire an asset that's going to fall in value over time when future you is going to have to pay it all back. Bad move. So, what are some things that depreciate in value? Luxuries, a new car. If you take on debt to cover a vacation, bad move. I mean, I'm not saying don't take a vacation. I'm not a monk and neither are you. And vacations are important. Recreation is important. These things allow us to rejuvenate and be our best selves, but you have to save for it and use it with money you've saved because a vacation is not an appreciating asset. In fact, from a broader lens, taking on debt to pay for any sort of consumption is probably a bad idea. Okay, so that's good debt and bad debt. And I want to add one little subtle thing. On top of good debt and bad debt, let's talk about really bad debt. And this would be unique classes of debt that are high interest. We're talking about debt where the APR, the interest that you're paying, is like bordering on, above 20%. So things like credit card debt, real bad. Mortgage debt's usually a pretty decent rate. Even car loans, which I don't think you should get, have a pretty decent rate usually. But, there's some really brutal high interest debt out there. And you understand TVM now. You understand the time value of money. You understand that the future value is equal to the present value times 1 plus the interest rate raised to the n. And therefore, that if this number, this interest rate on your debt is higher, especially higher than 20%, the math of this formula will crush you and will really hurt future you. So that's a little bit about debt. How do you want to control it then? You say, okay, I know that I have to maintain my debt and be cautious. What are some rules of thumb? Well, banks deal with debt and risk all the time. So banks have put together metrics by which they judge you. My view has always been, if the bank has a metric by which they're going to judge my safety and my trustworthiness, it's probably a safe move for me and a simple move, kind of an elegant move for me to just apply that same test to myself. So let me share with you 3 debt ratios. Okay? Debt ratios are basically ratios of one number to another, and they provide us with rules of thumb and rules of guidance to control our debt loads. Okay? First one, it's actually called your debt ratio, and this is equal to your total debts minus your total assets. Notice that you could read this off of a net worth statement, which has your liability line and your asset line. Total debts divided by total assets basically gives you an idea of how much you owe relative to how much you have. Lower is always better for that number. Zero would imply you have no debt, which is beautiful. If that number is greater than one, you've got a big problem because a debt ratio greater than one means you owe more money out than you even have. You have a higher liability base than an asset base, and that puts you in a real scary situation. And obviously, if that were the case, you know, again, systems thinking, income goes to obligations, luxuries, and savings investment. I mean, if you have a debt ratio greater than one, almost all of your income goes to paying debt. Not only will you starve yourself and future you of savings, but even current you won't have any chance to enjoy even the small luxuries that make life really pleasant. So you got to be careful. Okay. The second debt ratio, this is called your debt payment ratio. And your debt payment ratio is equal to the total amount of your monthly debt payments divided by the total of your monthly net income. So your debt payment ratio is how much money do you have to pay per month for your debts? Car loans, student loans, things of that nature, divided by how much money you bring in from your job after taxes, because net is after taxes. The general rule of thumb here, you want 20% max, okay? You do not want your debt payment ratio to be over 20%. Because if it is, I mean, 20% of your money, of your income, 20% of your take home pay goes to debt. That leaves you with only 80%. And that's got to cover your obligations. It's got to cover your housing, your food, your energy, some small luxuries, and saving for future you and investing for future you. Okay. It's really easy to get out of hand with like crippling debt. And we know the system's view of that visually. So 20% max is the debt payment ratio rule of thumb. And then the final one is when you buy a home, this is known as your mortgage debt service ratio. Your mortgage debt service ratio is basically how much money your housing takes up of your budget. So this is going to be equal to pity, excuse me. Sorry about that. Pity divided by your gross monthly income. Now, pity is a term that we use in housing, and you'll learn pity in the mortgage lectures. Pity stands for principal and interest. These two together, the principal and interest, make up your mortgage payment. Property taxes and insurance. Pity, therefore, is your mortgage, your property tax, and your insurance. It's the sort of shorthand term that we use for how much housing costs you. Your pity divided by your gross monthly income. There's a lot of rules of thumb here, and we'll learn those rules of thumb in the housing lecture and the housing and mortgage lecture. But we would say that this should be like 33% max. There's an expression of buying too much house. Buying too much house means you buy a house that's just too damn big for you and too expensive. And you end up spending so much of your money towards your house that you starve your cash flow for all your other needs and for your future investing. Okay, we'll learn more about this, but I wanted to plant the seed of that right now. Okay. Final thing that we want to talk about today, well, there's a couple more things. I want to talk about your credit score. Your credit score, which is also known as your FICO, because the credit score was invented by the Fair Isaac Company, so it still carries the name FICO. Your credit score, your FICO score, is a numerical representation of your trustworthiness. The FICO score spans from 350 to 850. It's a critical part of your financial future. The reason why is because your FICO affects many things. Your FICO affects your ability to get an apartment. Your FICO score affects the APR that you will pay on loans. All of loans is a risk function. Banks want to minimize risk. The riskier you are, the higher the interest rate the bank will charge you. And as we learn from time value of money, higher interest rates mean higher interest payments, and that starves your cash out. It's not good. So you want to have a great FICO score so that you can benefit from getting good employment opportunities, good housing opportunities, and lower interest rates. Okay? Just so you know, a FICO below 580 is considered poor. And if you have that FICO score, you're going to be poor. So fix it. A FICO between 580 and 669 is considered fair. 670 to 739 is considered good. 740 to 799 is considered very good. And when you break 800, you have exceptional credit. And you're going to have the best mortgage offers, the best credit card offers, pay the lowest rates possible, and it's going to be good. So, given this, how do you build up a good FICO score? Well, there's 5 criteria that determine your FICO. The first one, your payment history. This is 35% of your FICO. You must make payments every month consistently. In other words, this comes down, do not miss a payment. Notice it doesn't mean you have to pay it off in full, but you have to make your monthly payments. Notice we're seeing here now, feeding back into earlier things, the importance of automation. Don't worry about missing payments. Automate your payments. Link your credit card or all your other debt accounts to your checking account. Set up an automatic payment every month for the amount that you determine on the due date of the bill. And then you'll never miss it. You set it once, and then it works like a clockwork system, like a well-refined system, like an architected structure under you. So, payment history. Number 2, credit utilization. Credit utilization is 30%. Credit utilization, this refers to your total debt amount divided by your credit limit. Your debt amount divided by your credit limit. I guess we could also say your debt amount, we can also call that your credit card or your debt balances divided by your credit limit. Banks want to see that below 30%. So if you have a credit limit of $10,000, you want to keep your debt load below 3,000. Okay, 30% is like the magic cutoff rate to get a good mark here. Me, I'm a bit of a stickler. My view, you should keep your credit utilization below 10%. You really want to use 10% or so of your overall credit card limit. Okay. If you have a credit card limit of 10,000 and you're rocking 8,000 a month in charges, that's an 80% utilization rate. The bank is going to find that very alarming. You're going to get dinged on this and see your FICO drop. The third part is the length of your credit history. How long have you had credit cards for? That's going to be 15%. You can't do much about that, but just, let time work for you and keep your earliest credit cards open so that your length of credit history is long. The fourth one is your credit mix. This is 10%. Your credit mix, I don't like this, but the FICO score favors you if you have different types of debt. So like some credit cards and maybe a mortgage and maybe a car loan, they want different types of debt. I don't like that. I think it's a rigged system designed to get you to take on more debt than you need to get this high credit score. To me, it's kind of a self-defeating thing. I don't play ball on this one. I just have credit cards that I pay off in full every month. I have no other debt, but credit mix is 10%. And then finally, new credit inquiries are another 10%. In other words, if you're applying for loans a lot or applying for credit cards a lot, the bank is going to see that as a little bit of an issue and you're going to get a ding. So that's the FICO score. Your goal is to keep that score as tight as possible. Keep it high, protect it like a fragile little baby. Okay? I also want to talk about credit reports. A credit report is a summary of your overall credit history. You're actually allowed to request free credit reports at this website. If you do a search for annualcreditreport.com, hit that, and you will get to this site. Annualcreditreport.com is an authorized provider. It's authorized by federal law. There are 3 credit reporting agencies. And on this site, so they are Equifax, Experian, and TransUnion. These are the 3 credit reporting agencies, and they build credit reports on you. Your credit report is a comprehensive list of your payment history, all of your current debt that you have, your current balances. It's a really comprehensive snapshot of you. You're going to want to check this frequently because you're going to want to make sure that it's accurate. So you go to annualcreditreport.com, you click request your free credit reports, and you request your free credit report. And it will be delivered to you as a PDF. Now, let me share with you another little idea. Let's talk about the ladder. You could hypothetically request all your credit scores. Oh, I should say, you're allowed to get 1 free report per year per company. Remember, there's 3 companies. You're allowed to get 1 free report from each of them per year. You could go at one time and get them all. But let me share with you the ladder. In January, you request it from company 1. So let's say you request it from Equifax. Let's make sure we got our names right. Go back to our screen. Yeah, Equifax, Experian, and TransUnion. Those are your three. So maybe every January you request it from Equifax. February, March, April, May. 4 months later in May, you request it from Experian. June, July, August, September. 4 months later in September, you request it from TransUnion. October, November, December, January, and then you're back to January. So if you follow the ladder, you can actually get a free report every 4 months. I recommend that you do that and that you look at them. Just make sure they're good and you're all right. Okay. That's our opening on debt. I just want to give you finally a couple strategies to eliminate debt. So if you do have a lot of debt and you realize now, wow, Young, I didn't know about this stuff. I need to get my debt level down. How do I do it? Let me offer you some strategies. And there's two primary strategies. Strategy number one is the snowball strategy. And strategy number two is the avalanche. Under the avalanche strategy, this is the one that most finance people recommend. You pay off your debt with the highest interest first. So suppose that you have, debt from three sources. Under the avalanche method, you pay the minimum on the two debts with the lowest interest rate, and then you dump the rest of your money available to pay down your debt with the highest interest rate. This is pretty technically sound from a finance point of view because you want to get rid of high interest debt. So under the avalanche method, pay the minimum to your lowest interest rate debts first, and then put the bulk of your money to your highest interest rate. You clear away your highest interest rate loan, then you go down to the next one and the next one. That's a good one. But there's also a great approach called the snowball effect. And whereas the avalanche is good from a fiscal point of view and a financial point of view because you're retiring the high interest rate first, the snowball, it's a mental one. It's behavioral. With the snowball, you pay off your smallest balance first. So let's say that you have debt from four companies. You have like four credit cards or four forms of debt. Under the snowball, you would pay the minimum due to your three highest number, not interest rate, highest balance debt. Then you would pour all the bulk of your money toward your lowest balance. The goal is clear your lowest balance debt first. The snowball advocates, and I'm one of them, we believe that by paying off debt, by getting at least one account down to zero, even if it was a little credit card with $250, you get it down to zero, you feel good. You reinforce good behavior. You get a psychic reward. All right, I got that down to zero, one down, three to go. It builds enthusiasm and habit and momentum. So those are your two strategies. But I will say this, if you're going to eliminate debt, it's important that you also ask a very hard question. You see, it's not enough to just get out of debt. You have to have the courage to ask the hard question, why did I get there in the future? I'm sorry, why did I get there in the first place? All debt results from spending being greater than income. That's a systems approach. So you want to get out of debt, and you're going to need to be consistent, and you're going to need to make sacrifices, but you're also going to need to ask yourself a really, really tough question. How the hell did I get in debt in the first place? Because this right here is the root cause of your debt. And if you don't solve this issue here, it's just a matter of time till you get back into debt. Okay? So learn to love yourself. Ask tough questions. Give yourself honest answers. Forgive yourself for past mistakes, but know that debt has the root cause of spending more than you earn. You have to address that. Otherwise, even if you get down to a zero balance, you're just going to build it back up again because debt is an underlying behavioral issue. So ultimately, we're looking at behavior. We're trying to gain awareness and we're trying to think, as always, in systems. Okay? So that's an intro to credit. Good job getting through this video. In our next ones, we'll cover credit cards and then loans, and then you'll be ready to move on in your journey. Have a great day, finance friends. Thank you for your time.